Hey everyone, Adam Simmons here from Dgtl Infra, short for Digital Infrastructure. In this video, we discuss why not all data centers are created equal. Data centers can broadly be placed into two main categories: retail data centers and wholesale data centers. In prior videos, we have gone over the detailed differences between these two types of facilities, so I will just provide a quick refresher now. Retail data centers are smaller facilities for customers that have smaller power requirements. Think less than half a megawatt. These data centers are often for enterprise customers. Examples of companies that fit in the retail category include Exxon, Gap, Walmart, and United Health. Wholesale data centers are larger facilities for customers that have significant power requirements. Think more than half a megawatt and usually multiple megawatt requirements. These data centers are often home to cloud service providers or large internet companies like Amazon Web Services or AWS, Microsoft Azure, Google Cloud, Facebook, Uber, Twitter, Netflix, Apple, and Salesforce. For our upcoming examples, we will focus on the operators which have a retail focus and have disclosed their financials publicly, which includes companies like Equinix, CoreSite, Iron Mountain, and Cyxtera. Also, we will be using the term retail colocation because these retail data centers are more than just data center facilities. Retail colocation allows for multiple tenants to co-locate their equipment in the same facility and take advantage of additional services within those facilities, such as managed IT. With that, let's discuss why not all data centers are created equal. The key issue we want to point out in this video is that yes, the data center industry as a whole is growing at a rapid pace, but certain types of data centers have been growing slower or not growing at all. This is because retail colocation is currently shrinking, and in the future will continue to shrink as well. Therefore, certain data center REITs and stocks that are overexposed to retail colocation is something to watch out for in the public markets. And the best examples we can look at to see these trends are the United States publicly traded data center stocks, or soon-to-be public data center stocks. Examples of publicly traded data center companies that have a significant retail colocation component to their business include Equinix, CoreSite, Iron Mountain, and Cyxtera. So why is retail colocation shrinking? Why is this happening? We will provide two key examples of why this is occurring now. Firstly, older facilities are leading to customer churn. Some retail colocation facilities are now 15 to 20 years old, and some even older. Therefore, they do not meet the network architecture needs of customers today. Additionally, they do not have modern power, backup power, or cooling systems. To say it differently, when these retail colocation facilities are benchmarked against data center certification standards, such as those from the Uptime Institute, these older facilities are graded as Tier 1 or Tier 2 data centers, meaning poor grades, while they are trying to pretend to be a Tier 3 data center or higher. Similar to hotel star rating systems, if you went on vacation to a sunny destination hoping to stay at a 4-star hotel, and when you showed up, the place felt like a tired, dirty, old 2-star hotel with rude staff, then you would probably be disappointed. The point is that because certain retail colocation facilities have become old and outdated, their customers are choosing to leave these facilities to go find other, newer, multi-tenant data center providers. Well, that makes logical sense, but how can we analyze this phenomenon, and how can we put some numbers behind it? Well, when retail colocation facilities lose customers, this shows up in their customer churn metrics, which the public data center companies report on a quarterly basis. Higher churn means that more customers are leaving. We will use CoreSite, Iron Mountain, Equinix, and Cyxtera as examples. So number one is CoreSite's churn in Q4 2020, meaning the quarter that ended December 31st, 2020, was 5.4%, which is double its typical quarterly average of 2 to 3%, and materially higher than at any time over the past 3 years, as shown on the graph. This was a result of a few customers moving out of CoreSite's facilities, most notably Uber, which vacated 5 megawatts of capacity in one of CoreSite's Silicon Valley data centers. Our second example is Iron Mountain's churn in Q4 2020 was 3.9%, which is well above the less than 1.5% average for its prior quarters. This was a result of customers moving out of one of Iron Mountain's Northern Virginia facilities. We can also see from the chart that Iron Mountain has been hit by significant churn in the past, with a similar churn spike in Q1 2019 at 5.1%. Our third example is Equinix's churn in both Q3 2020 and Q4 2020 has been above 2.5%, as compared to the company's guidance of 2 to 2.5% per quarter, and historically Equinix's churn being below 2.5%. Equinix notes that the recent churn uptick has been from unforecasted churn. We would note that given Equinix is one of the premier data center operators, the magnitude of churn uptick recently has been less than its peers. Finally, our fourth example is Cyxtera, which will soon be another public data center operator focused on retail colocation. It's currently privately held by private equity investors. In late February 2021, Starboard Value Acquisition Corp., a publicly traded special purpose acquisition company, also known as a SPAC, announced it will be combining with Cyxtera in a $3.4 billion deal, which is expected to close in mid-2021. Thus far, Cyxtera only discloses a metric called core churn, as seen on screen, which we actually find completely disingenuous. Cyxtera makes a small footnote, number 2, at the bottom of the page which reads, core churn defined as churn excluding CTL as a customer. Note that CTL stands for CenturyLink, which is now called Lumen Technologies. But more importantly, Lumen, or CenturyLink, is Cyxtera's largest customer, at 13% of revenues. Therefore, Cyxtera is effectively excluding their largest customer, which has experienced churn, from their overall churn metrics, with this bogus metric called core churn. Overall, with Cyxtera, we will wait for more appropriate disclosure from the company, which, if they provide it, will show their true churn is well above the sub 1% figure, which they claim on screen through their core churn metric. So that is point number 1 as to why retail colocation is shrinking. To reiterate, older facilities are leading to customer churn. The second point as to why retail colocation is shrinking is that customers of these retail colocation facilities are migrating to the cloud. And as discussed at the beginning of this video, these cloud service providers primarily locate in wholesale data centers, not retail data centers. With growing acceptance of cloud-based technologies, retail colocation is losing customers that decide to fully leverage cloud infrastructure offerings instead of managing their own. Simply put, customers are choosing to migrate their data to a cloud service provider, which the industry often refers to as hyperscale cloud providers. It does not mean that data center customers are going away. However, it means that these different types of data center providers are winning customers from retail colocation. These hyperscale cloud providers are well-recognized names and include the likes of Amazon Web Services, or AWS, Microsoft Azure, and Google Cloud. We can see this trend through numbers by analyzing the cloud infrastructure service revenues of the largest cloud service providers, which for full year 2020 reached in aggregate total revenue of $130 billion, up from $100 billion in 2019. This represents a staggering growth rate of 30% year over year. So that is point number 2 as to why retail colocation is shrinking. To reiterate, customers of retail colocation facilities are migrating to the cloud, which in part is for simplicity of managing their IT infrastructure, and also because it is often cheaper for them to do so. With those two fact patterns in mind, what are some of the storylines, and how are data center operators pivoting their business? So number one is shrewd operators like Dgtl Realty have been doing M&A to sell off some of their old retail colocation facilities to less experienced data center investors. If you want to learn more about that, then visit us at dgtlinfra.com to check out the article, Dgtl Realty sells 11 data centers to Ascendus REIT for $672 million. The second storyline is that other traditionally retail-focused data center operators like Equinix have been moving into the hyperscale data center business to cover up for some of this loss in retail colocation. If you want to understand more about that, then visit us at dgtlinfra.com to check out the article, Equinix xScale joint venture grows in Europe, Asia Pacific. Finally, number 3, which is probably the most troubling, is that more of these data center companies that are overexposed to retail colocation are being taken public in order to pass off their ownership to less sophisticated investors. Particularly, this is the case through special purpose acquisition companies, or SPACs, which have become such a prevalent phenomenon recently. If you want to read more about that before the transaction is completed, then visit us at dgtlinfra.com to check out the article, Cyxtera Technologies acquired by Starboard Value Acquisition for $3.4 billion. As always, we will link to these articles in the description below. With that, thanks for watching, and I'll see you in the next video.